Cypress Financial Group presents the Retirement Roundtable Podcast with John Scallan. Get more at cypressfinancial.net. Now, let's get to the show.
My name is Mark Owens. And John, I want to get right into it here this weekend because we've been really diving deep into the community and the adults you serve and what's really on their mind. We've been getting a lot of calls from adults who are 10 years out, 12 years out, 8 years from retirement. Why do you think that is? Is it because they see what's happening geopolitically and they're worried about their financial future? Or is it because they have a better education about retirement? What are you hearing from the families you serve?
Well, good morning to you, my friend, and what a great way to start the show. I mean, Mark, I think, at first blush, I would say it's a little bit of both. Mark, I mean, who is not a little bit rattled by all the volatility in the market, the geopolitical, the economic challenges, the political discord? I think people are generally concerned. I mean, if you're over 40 years old and you've been putting money away in a 401k, I can tell you, I ride bikes with a bunch of younger guys. Mark, all they want to talk about is the 401k. Right? I'm out there to get a little peace and quiet and relax a little bit. And they're like, you're the radio guy. They are very engaged. They're very concerned. And, Mark, so yes, it's the volatility. Yes, it's what's going on in this noisy world. But as you mentioned, people are educated. There's a lot of information coming from a lot of places. And Mark, quite frankly, it is refreshing to see young people engaged in building a better future. So short answer, absolutely a little bit of both.
Makes total sense. So if you're in that 10-year window, reach out to the team at Cypress Financial. Nothing wrong with asking the questions and getting a plan started. 504-732-1001, cypressfinancial.net. And John, I came across a Georgetown study that's pretty eye-opening. They found that small investment fees can quietly take tens of thousands of dollars out of retirement savings over time. And here's the kicker, John. Most investors, they don't even focus on the fees when they're making decisions. They're looking at performance, not what it costs them. Are the families you serve, are they catching little elements of their retirement portfolio like this?
Mark, almost never. I mean, literally almost never. You know what fees are like? They're like a leak in your retirement boat. Right? You're not sinking today. You're not sinking tomorrow. But the water, it's slowly rising. And if nobody patches the hole, eventually it's going to become a real problem. Mark, let's talk about a hypothetical situation. Let's say we had a very talented and successful young lady in her early 80s, drove up from a small town down the river, heard us on the radio. She had about $500,000 and she thought everything was fine because her account was growing, right? We've been in a fairly long bull market cycle. But, when we actually sat down and looked at what she was paying, her advisor was charging her 1.5% as an advisory fee. And on top of that, the funds that she was invested in had expense ratios of over 1%. She was coming in total cost over 2.5%. And Mark, when you do the math on that $500,000, we're talking about $12,500 a year just quietly leaving her account.
And that's not over accumulated 4 to 5 years. You're saying $12,500 every single year.
Every single year. And that's money she's already earned, already saved. It's just draining out through a hole that she didn't even know was there. Mark, we're not talking about some distant future. We're talking over $1,000 a month, every month, happening right now, regardless of whether the market is up or down.
Did she have any inclination that the fees were totaling that much?
Absolutely none. I mean, her advisor was someone she'd known for years. She trusted him completely. But when we asked what he was actually doing for the 1.5%. We asked, is there tax planning? She said no. Social security strategy? She said no. Estate coordination? He was rebalancing the portfolio once per year, and that was it. And here's the thing. Fees are not always easy to spot. She saw one number on her statement, but those were the advisor fees. Then you've got fund expenses, multiple layers of fees potentially buried in fine print. Most people are paying more than they realize and only aware of one piece of that puzzle.
Okay, so everybody's situation is a little bit different when it comes to how much they're paying in fees. But in a hypothetical, in a situation like this, what could you do for an adult who's paying fees that they don't know how much it's costing them per year?
I mean, Mark, this is remedial standard operating protocol for every time we engage a client. We do a fee audit, lay everything out, what she's paying, what she's getting, whether it makes sense. And then we patch the leak. We get her into funds that have historically had better returns. We reduced her total cost significantly and actually gave her the comprehensive planning she was paying for but did not receive. Now, look, Mark, we have a saying, fees are only an issue in the absence of value. They're not always bad. Listen, if you are getting comprehensive planning, tax strategy, Social Security, estate coordination, then 1.5% would be completely worth it. But if all you're getting is a quarterly rebalancing, that's really an expensive leak in your portfolio.
So, John, the question isn't really just what you're paying, it's the value. It's what you're getting for what you're paying in fees.
That is exactly it. Fees compound against you really, in some cases, very quietly, but you can't patch a leak you don't know is there.
All right, so somebody may not know. They may have a leak in their retirement boat. Can you sit down and do you offer like a comprehensive fee x-ray, or how do you help somebody find these hidden fees?
I mean, Mark, we talk about this a lot. I mean, we really have an average of a 3-appointment process. You know, appointment number 1, we're just getting to know you. We don't talk a lot about product. We don't talk about fees. But as we move into that second appointment, we're doing a deep dive, what we call a portfolio X-ray. Just bring in your statements and we'll break down exactly what you're paying and what you're getting for it. And remember, all of these initial meetings are always complimentary. Leave your checkbook in the car.
CypressFinancial.net, or one more time, 504-732-1001. John, I was reading data from the Employee Benefit Research Institute because I guess I'm that big of a nerd. But listen, the numbers are pretty striking. Only 3% of retirees have saved over $1 million. So that means 97% of adults are retiring on less than $1 million. A lot of them probably wondering if that's enough. So we always talk about that magic number that you hear that you have to have for retirement. Does that match what you're seeing? I can retire on less than $1 million?
Well, hang on, Mark. Let me pick myself up off the floor. I mean, anybody reading the Employee Benefit Research Institute tax manual, oh my gosh. Listen,
I thought you'd be proud, John. I'm really trying to educate myself a little bit more.
Really impressive. But Mark, so back to your question, does this match what we're seeing? I mean, it does, Mark. And the first thing I tell people is simply that $1 million number isn't a retirement standard. What I think it is, it's a round number that's been repeated enough times that people started treating it like the finish line. Here's the real question. It's never how much you have. It's whether what you have covers the gap between your guaranteed income and what your life, what your retirement actually costs.
I want to focus on a word you just said there, John, gap. So what exactly does that gap look like in practice?
Mark, when we sit down with someone, I mean, the first thing we look at isn't the savings balance. It's simply their monthly expenses versus their guaranteed income. Social Security, pension, anything that shows up no matter what the market does. The people who retire most comfortably, Mark, they're usually the ones where those two numbers are very close together. The ones who run into trouble are the ones with a big gap, a lot of distance between, those two equations, and they don't realize that the gap is too large until it's almost too late.
And so what you're saying, most people don't really know what that gap looks like until somebody like you actually shows them.
That is exactly right, my friend. And here's what makes it dangerous. Inflation. Hypothetically, a gentleman comes in from Homa. Let's say he's 62 years old, planning to retire at 63, had about $700,000 in his IRA. His Social Security was going to be about $2,400 a month. His wife had a smaller benefit, let's say $900 a month. So here's the math. Together, they're looking at roughly $3,300 a month in guaranteed income.
All right, I got to stop you there and say, on the surface, that looks reasonable.
Mark, it does until you look at what their particular retirement costs, what their expenses are. I mean, let's say they were spending $10,000 a month. So right out of the gate, before he retires, a single day, there's $6,700 in a monthly gap that has to come entirely out of that IRA every single month.
So all the heavy lifting is being done from the portfolio.
Very well said. Day one, the portfolio has to pull a huge load, all of it. And now if you layer in inflation, let's just say it's 3% per year. Let's do the math. That $10,000 in monthly expenses becomes $13,000 a month by the time he's 72. And we're just talking about 3% per year. It's $15,000 per month by the time he's 77. And the gap keeps getting wider and wider. And think about it. The IRA keeps shrinking faster and faster just to keep up. Again, let's say we run the full projection. He's looking at running out of money at around 82 years old.
I know this is a hypothetical situation that we're putting together with this gentleman here, but even to see that information running out of money at the age of 82 when we're all living longer, that's a hard number. That's a hard reality to see on paper, John.
Yeah, I mean, here's the thing. Now he knows. He's not happy about it, but he's got time to fix it. We would walk him through the options and, help him make a better decision. Mark, maybe it's worked 2 more years. Maybe it's let his Social Security grow a little more and then go into the retirement with a plan that actually holds up. I mean, in this situation, he probably wouldn't walk out happy about working longer, but he'll walk out of our office with confidence. And that's a whole lot better than walking out at 63 years old and finding out that at age 79, the money is almost gone.
So with an appointment, with the conversation with you and the team at Cypress Financial, you could help save us from a very painful discovery down the road.
Mark, that's exactly why we do this exercise. Some people come in and find out that they're in great shape. Others find out they need to make adjustments. But either way, they know. Mark, knowledge is not power. Power is when you have the knowledge and you act upon it. And this particular knowledge gives you options. Waiting simply doesn't do it.
All right, so we mentioned the word gap, and we kind of defined the gap in our portfolio. And somebody's listening this weekend, and they would find out what their gap looks like. John, what's the best way to reach out to you and the team to schedule that consultation?
We're always thrilled to get calls from our listeners. Pick up the phone, 504-732-1001. We will look at your guaranteed income, your expenses, and show you exactly what your specific retirement picture looks like, including what inflation does to it over time. Again, initial meetings complimentary. Don't wait until the numbers force your hand. Get a plan. Let us help you with that plan. Pick up the phone.
And John, multiple opportunities, multiple offices of Cypress Financial, so you can serve the community how it's most convenient for our schedule. Where can we find you?
in the heart of Metairie on North Causeway Boulevard, on the North Shore, Florida Street in Mandeville. Listen, we will meet with you where you are. I mean, not just physically. We do Zoom calls. We do Teams calls. We meet clients at their offices, at their homes, whatever works best for you. This information can be priceless, and we'd love the opportunity to get to meet you and to share this information with you and your family.
We do have a representative standing by right now, 504-732-1001, online, cypressfinancial.net. Always thinking about your income, your risk, taxes, and retirement. And speaking of income, here's something that caught my eye. Last year, $464 billion, with a B, billion worth of annuities were sold in the United States. John, that is a record. But if you turn on the TV or, hear some of these commercials, all you maybe think is that annuities are terrible.
Well, Mark, I'll give you my opinion on exactly what's going on.
Please do.
A lot of the anti-annuity noise comes from investment companies that actually don't sell them. If you can't offer something, sometimes it's in your interest to tell people it's bad. That's not consumer advice to me, Mark. That's just plain old marketing.
So, John, when it comes to all of the negativity around annuities, some of it isn't based in fact, but it could be more manufactured.
Well, Mark, I would say partly. Is it all manufactured? I'd say absolutely not. There are genuinely annuities that have been marketed in this country in the past that were not really good products. You have some variable annuities with sky-high fees and, long 10-year surrender charges. There have been indexed products that promise market upside and deliver, in some cases, very little. Those products in the past, they deserve every bit of criticism they get. And honestly, I'll be the first to tell a client in that scenario to walk away from that product. But Mark, here's what gets lost in all of the noise. Annuities aren't just one thing. There's a whole category of products that can serve very different purposes inside a retirement plan. And when the right type is matched to the right problem, these can be very effective and powerful financial tools.
You said when the right type of annuity is matched to the right problem. I want to go deeper with that. What kind of problems are we talking about?
Well, Mark, let's talk about three major problems. First, guaranteed lifetime income. Money you cannot outlive no matter what is happening in the stock market. Number two, long-term care benefits. There are annuities that do double duty. They provide income for life. They provide income for your family, but also include long-term care protection. So your money is essentially working two jobs at once. Here's the third, market growth with downside protection. Let me say that again. Market growth with 100% downside protection. You participate when the market goes up, but you've got a floor so you don't get wiped out when the market drops significantly.
So something to cover pretty much all of your needs when it comes to income with an annuity.
I mean, Mark, that's a great point. I mean, here's what I think we're genuinely different from many financial advisory firms. We are independent. We can access the best annuity products out there if and only if the situation calls for it. But we also predominantly manage money in the market. We've got modeled portfolios for growth and income. We're not limited to just one toolbox. Some advisors have a hammer, Mark, so everything ends up to them looking like a nail. Our only job at Cypress Financial is to figure out which combination of products actually fits your specific situation.
I don't want to put words in your mouth, and I don't want to speak for you, John Scallan and the team at Cypress Financial, but there's no agenda. The only goal is to build retirement strategies that fit your clients' needs.
Mark, the word I just mentioned a moments ago, independent. We are not beholden to any company, any financial firm. We work for our clients. Here's the point. This is real money. In most of the situations we're talking to people, this is their life's work in terms of what they've accumulated. Mark, hypothetically, a gentleman from the North Shore, $600,000 saved, needs about $40,000 a year to live on. Let's say Social Security covers $25,000 of that $40,000, so he needs $15,000 a year from his savings just to, make sure everything is covered in retirement. He potentially walks in saying, I will never buy an annuity, never. But when we ran his numbers, we show him put $300,000 into a simple, no fee, fixed annuity with a guaranteed rate as high as 6%. This would generate him in excess of $16,000, $17,000 per year, guaranteed, no market risk. Mark, here's what happens to the other $300,000. It stays in the market, it's invested, and it keeps growing.
And his mind was changed.
Absolutely. I mean, because in this particular situation, he was able to see what it was actually doing for him. That guaranteed income meant the $300,000 in the market did not have to generate the additional paycheck anymore. It can just grow and roll up. He didn't have to lie awake worrying about, a down year because his income, his expenses, right? These expenses that he needed, to live on comfortably, they were already covered. That's what the annuity did for him. Not because the annuity is the answer to everything, but because it was the right tool for that specific problem.
The question isn't whether you like annuities or hate them, it's...
Mark, I would say it's whether one actually solves a real problem in your plan, solves a real problem that helps you rest and sleep easy at night. And Mark, the only way to know that is to look at your full picture, your income, your expenses, your gap in terms of guaranteed income versus not, your timeline. Some people will walk out of our office with an annuity as part of their plan. Some won't need one at all, but everyone across the board walks out knowing exactly where they stand.
A lot of layers to an annuity. It could benefit your overall retirement plan. John, if somebody wants to find out which approach would fit their situation, how can they reach out?
Mark, this is really simple. We're going to look at your full picture, no agenda, no pressure. If an annuity makes sense, we'll show you exactly why and which type fits best. If it doesn't, we're going to show you that too. Initial meetings are always complimentary. 504-732-1001. It would truly be an honor, truly be a privilege to sit down, to meet you, and talk about what makes sense to you.
Insurance products are offered through the insurance business Cypress Financial Group. Cypress Financial Group is also an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Cypress Financial Group are not subject to investment advisor requirements. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Cypress Financial Group is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Cypress Financial Group. This radio show is a paid placement.
Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Please note it is not possible to invest directly into the S&P 500 index. This measure is provided solely as a gauge of overall market performance. Standard & Poor's, S&P, and S&P 500 are registered trademarks of Standard & Poor's Financial Services, LLC, S&P. The historical performance of the S&P 500 is not intended as an indication of its future performance and is not guaranteed.